some of the wealthiest people on earth, if you look at the Forbes 100 list, almost a majority of them is from the fund or financial space. This game is what creates some of the wealthiest people on earth.
Welcome. This is the Hot Real Estate Investing Podcast, a podcast dedicated to helping others through real estate investing. Our hosts interview guests from all aspects of real estate investing who generously share valuable experiences and advice. Whether you're starting out or an experienced investor, this is the show for you.
Hello, and how's it going? Welcome to the Hot Real Estate Investing Podcast. My name is Travis Shelton. On this show, I interview guests who want to help others investing in real estate. It is my pleasure today to have a really special guest, someone who empowers people like myself to launch and scale funds. He has over 50,000 students and coached hundreds of aspiring and emerging managers to start their own funds. His students manage over $1 billion in assets. It is my pleasure to introduce the co-founder of Fund Launch, father, and fund manager, Bridger Pennington. Bridger, thanks for joining me today.
Wow, what an intro. Thank you, Travis. That was awesome, man. Good to be on.
Yeah, absolutely. Well, I shared a little bit about your background, but tell our audience more. What's your story? Tell us a little bit more about yourself.
Well, I'll give you the 30-second boilerplate, and then you can dive in if you want. But we run a company called Fund Launch. Like you said, 50,000 students. We throw a bunch of live events. Our whole goal is to just help more people launch funds. I've ran 2 funds prior, ran 2 debt funds. Prior actually sold the second one, had a competitor come buy us out, and we did a whole exit on that fund, which was pretty cool. Currently, I run a hedge fund. We just raised $10 million in initial launch on that, and we're growing that right now. It's pretty awesome. So I run a hedge fund currently, and then we run a company called Fund Launch that helps people launch funds. And the whole goal of that is just help more people learn this game. We bring in mentors and coaches from all over the world to help teach and just share this game, because in reality, no one really talks about this game and the actual how to do it. People talk about private equity and hedge funds and real estate funds, but no one actually knows what that means. What does it mean to run a real estate fund? What does that actually entail? What are the filings? How do you do with the SEC? What licenses do you need? That kind of stuff. And so we've helped. It's been really cool. And Travis, you've been to some of our events and been part of our group and stuff. It's been really cool to see you grow in this space and what you're doing as well. So congrats to you. And it's just been, that's what we do. We're trying to help tons of people get in this space, and our goal is to decentralize Wall Street. There's these big firms, BlackRock, Vanguard, these massive firms that are, can kind of control the world, and these huge multi-hundred billionaires that run funds, and they use all the same vehicle of a fund. Yet regular people like me and you don't understand how it works. And so my goal is to help more people understand this game first off, and then hopefully even leverage this game in their own business and own investments, what they're doing.
No, that's amazing. And yeah, you have certainly helped me and my partner, Jason, and actually excited to share with you. Our initial fund docs should be tomorrow, is what our legal team told us. We should
That's
have those
awesome.
initial
Congrats.
docs. Thank you. It's still a little bit in the process, but I know your team and all the coaches have saved us so much time and probably so much money with reiterations, going back and forth illegal and reshaping our thesis and really our focus for our fund. So thank you and to the Fund Launch team a lot. So we always start our shows off with a little bit of motivation. And so I know you shared a motivational quote with us. Do you want to share that with the audience?
Did you have one in mind?
It was get in the habit of go-giving.
Yes, I love that quote. I have a bunch of, it's funny. Sorry, I fumbled over that just because I have, it's funny. I from week to week, I have a quote in the back of my brain that kind of just drives me. And I don't know if you do that. I've done this for years and I don't do it. I just do it naturally. There's that something in the back of my brain, just pushes you and keeps in your, kind of spins around in your head. And so this week it was different. Last week though, when I submitted it, yes, get in the habit of go getting was the one that was just always in my brain. And the concept is to be a go-giver. There's actually a great book called The Go-Giver. And it talks all about being in the mindset of giving always. Some people write a big check at the end of the year, which is fantastic. That's actually phenomenal. A lot of people just don't ever give to charity. Some people write a big check at the end of the year, which is totally fine and great as well. But the concept of, if you want to truly be happy with giving, have the concept of I'm always giving and always have, $100 on you, or in the mindset of if I meet somebody in 5 seconds, I'm going to give them money or time or a contact or something. And it's a really fun way to live life. And me and my wife, actually, it was last year, we set a budget. We actually pulled out money, like cash, out of our bank account. We said, this is our money. We're going to do, at the time, it was like $50 a week. And we got $50 bills, both of us. It was $100 total a week that we were going to find somebody at the grocery store or somewhere we're going to give this money to. And so and I personally, I don't love giving money to homeless people. This is just me. Yeah. I like giving money to like working people that are like working, but struggling, like the cashier at Smith's. Like I love giving money to the cashier at Smith's, or like the guy that's like my waiter, or I don't know. I love working people. I just love that. And so
we started doing that. To give it somebody that wants to help themselves and actually working for it. I remember I used to, when I was a teenager, I'd actually go out and I'd go to like a 7-Eleven and I would just take homeless people in and actually buy them like hot dogs and Slurpees and like buy them things to food versus just giving them money. So I totally agree. I think giving back, and that's what this podcast honestly is all about. My business, it's Hot REI, stands for helping others through real estate investing. And it all comes from the premise that, you can have everything you want in life if you'll just help enough other people get what they want in life, right? That Zig Ziglar quote. And that's the whole basis of my business and this podcast. So it's just giving. And I really appreciate your time today, because I know how valuable it is to come and give to the audience of real estate investors that watch this show. So thank you. You are truly a go-giver, my friend, and appreciate your time. Yeah. So transitioning into our main transitioning into our main topic, as an expert in fund management and launching funds, how can you help our audience of real estate investors? And maybe we can start at like, how did you get started in a fund? What is a fund? And maybe just a little bit more background there.
Yeah, I'll tell you my background story. I'll go quick through it. But I think it gives you, there's some good context, good lessons along the line. So I grew up in a very normal household. My dad was an entrepreneur growing up, and I didn't really know what he did. And anyways, we grew up in just a normal house, nothing bad, nothing good, but just normal. I went to college. Anyways, long story. I'll save you some of the details, but I come to find out my dad is running an $8 billion family of funds. And I started all these businesses in college. I started a Chinese tutoring business. I actually wholesaled 2 houses in college, all this stuff. And finally my dad's like, dude, and I talked to his business partner. Anyways, I come to find out my dad has made tons of money, doesn't show it, kind of hides it, and is running an $8 billion family of real estate funds. To put that in perspective, that's twice as big as Cardone Capital is today. Okay, that's how big they are at the time. Today, now my dad's since retired, but they are over $45 billion AUM, top 5 real estate fund in the world. So 10 times Cardone Capital, which is pretty phenomenal. And so, as I learned this, I'm 22 years old, and I'm like, Dad, you got to teach me about, funds. And so I'd go to his house, and every Sunday night he'd teach me, we'd get on the whiteboard. He taught me about how funds work, how to raise money, what they are, how to build them, how to structure them. We probably will dive into that in just a minute, but the whole concept around funds. And, I learned this whole game, and it's funny, but things about life, when you start to learn something, you start to recognize that thing in your life. So if you ever buy like a new car, you'll start to see that car everywhere. It's not like there's magically more cars. It's just the fact that you started to pay attention to that thing. So I learned about funds, and I started to pay attention to that thing of funds. And I was in college. I was working at actually a job and an internship. At the internship I was at, I saw an opportunity where we could do a fund inside of this company. They had clients coming in that needed financing, these short-term deals and financing they needed. Anyways, I talked to the CEO. He loved the idea. So we actually built out and started to structure this fund. I was 22 years old at the time. I started to put together the pieces of a fund. And it was so awesome. I was so excited. I'm like, man, I'm going to run a fund. I'm going to follow my dad's footsteps. It's going to be amazing. And I hit this wall. I was like, crap. Now I got to go raise money. Like, what am I going to do? And I thought, aha, easy. I'll go talk to my dad. Apparently my dad is super rich. He doesn't spend his money. He drives kind of a crappy car, all this stuff. He's like, he doesn't spend his money on cars or planes or anything. He just likes to save and invest his money. So great, he can invest with me. And so I remember it was late Sunday night. I went and talked to my dad. I sat down in his home office and I said, Dad, how would you like to be our first investor into our fund? And my dad kind of smiled and laughed. And he said, Bridger, he goes, I have the money to invest, but if I invest in your fund, it would ruin the experience of you raising money on your own. This will be a crutch that you'll never be able to recover from if I invest in your fund. Mm-hmm. And he said, no. And he kicked me out and he said, you got to go learn this on your own. And so he kicked me out. I kind of walked out with my tail between my legs a little bit. And I said, you know what? I'm going to go do this. And so I went out, I talked to everybody I knew. I talked to former bosses, college professors, friends, whoever it was. I ended up raising a grand total of $49,500 from, I think, 7 investors. So pretty small. If you guys know anything about funds, it's like probably the smallest fund ever to launch. But it was enough to get started. We were doing these short-term loans. They were $2,000 to maybe $7,000 a loan, and we could turn them every 2 to 3 months. And so we started doing these loans. Our first group of investors, we got them a 64% return on their money. So a small amount of money, but good percentage return. We then dovetailed that into we called it our second fund, where we filed our Form D and did all the official stuff. And we raised and deployed millions of dollars out of that fund. I ran that fund for about 3.5, 4 years, did phenomenal. Our investors got huge double-digit returns, cash on cash. Every month I'd pay a check to my investors. It was just awesome. And we ended up having a competitor come and buy that fund out, which was amazing. And then during that time period, so my dad is running these massive multi-billion-dollar funds. My brother is also an investment funds attorney. And then I run my own funds. And by the way, till this day, my dad has still never invested in a fund, a deal, anything I've ever done. And which is pretty cool, actually. But he's been a great mentor and coach. And so we started to put out content online. And we started this kind of small course. We started throwing live events where we started to help people have access essentially to what I had an incredible father. He didn't go to Ivy League school. He's not like well educated. He's just a regular Joe. He grew up in ghetto North Las Vegas and got kind of C's and B's in college and ended up running a $10 fund, which is just so cool. He's got this incredible story. And so cool. We started to give access to other people to like, hey, you want to learn the same thing. And so we started to build this small community, and it's gotten bigger and bigger to where it's, today it's just crazy how big it is. But that's kind of the story, how this all came to be. And then last year we launched a brand new hedge fund. I have a couple of partners that are incredible at cryptocurrencies. We don't trade, but we have an incredible basket of goods. And anyways, we launched a fund. It's done phenomenal actually during this whole crypto winter we're in. It's actually done very, very well. So I currently run that fund, and now we now advise specifically. We're a small minority advisor. We have a minority rev share on 8 different funds that we're working with, and we're looking to expand that to 15 funds right now in our group as well. So kind of cool.
No, I love it.
And sorry, I don't know what questions you asked me. That's kind of my background story.
No, you have such a great story. I didn't want to cut you off, and I love that story, and I think it's so inspiring for other people, and especially people raising money that, the first people you're going to go to are friends and family, right? If they say no, I think a lot of people would tuck their tail between their legs or say like, hey, this isn't for me, right? Or that first raise of, just sub of $50,000, right? When 50,000 is a lot of times the entry into a fund or into a syndication. And so, to show that track record. And I think a lot of people think real estate especially is a get rich quick, or this fund world is a get rich quick. And I think one thing you've definitely shared and taught myself is, this is a long-term game, and this is a long-term wealth game that takes a lot of years to build your reputation and your resume up. And I love seeing your growth and hearing your story. So really appreciate you sharing that with the audience. What's one of maybe the most common myth that you hear about funds in general, and why maybe people don't? Like you said, it's like kind of this unknown thing. It's under a rock. Like I kind of stumbled into finding your group even. So why don't more people know about it, or what are some myths you hear about funds?
Well, a couple myths. You got to work on Wall Street for 25 years to start a fund. You have to go to an Ivy League school to start a fund. You got to be born with whatever certain last name to start a fund. And by the way, these aren't uncommon things. A lot of us tell ourselves this all the time. Oh, that's, that amount of wealth or that kind of car is only driven by this type of people. And what happens is we build this mental block in our brain that discounts us from them and gives ourselves essentially an excuse of why we can't be successful. I think it's funny. I coach a lot of entrepreneurs, and typically the biggest thing that stops them and even myself is mindset. And not just vision and goals, but the voice we talk to ourselves with in the back of our brain. A lot of times it's because, mom or that uncle or that brother is, not happy for your success or holding your back, or keeps telling you you're changing. You're not the guy I remember growing up with. Well, yeah, I'm changing because I'm getting out of this crappy state to an incredible state. And yeah, I'm going to change and grow out of that. And what happens is a lot of these people, usually family members, pull us back down. And so that's one of the biggest misconceptions. A couple other things we can dive into. You need a crazy amount of licenses and regulations. Yes, the space is regulated, but it's not that crazy. You just got to understand the rules, and then you play within the rules. Yep. It's kind of like the analogy I always show is if someone someone had never seen American football before and walked into Raiders Stadium and watched this game, they'd be pretty confused. I mean, you have punts, like what's a third down? Why is there what's a field goal? Like, what are these things? Like this, it's actually a very confusing sport. But and maybe you just look at it and say, it's too much for me, I don't want to watch. But if someone else sat down with you, like a coach or somebody, and showed you the game and talked you through it for 20 minutes, you'd probably be able to quickly understand what this game was and how to play it. And maybe you'd even develop a strategy around the game. And that's what I like to think about with the SEC and with elite regulation in the United States is they've given us lines and painted, but inside the game, there's a lot of strategies you can play within the game. As long as you understand that there's, a sideline of field goals and punts and other stuff like that, you can really play this game really well. And so that's what we try to teach online. And you've been a part of that is we try to help people understand the games and the rules. And then you can play all the strategies and all the cool stuff. And what actually it does is actually protects you from going to jail or you hear these crazy stories of people that go to jail for 20 years and stuff that commit fraud. And typically they actually almost always, they understood the rules and then broke them on purpose is typically what happens. People don't just wake up and go to jail one day. They understood the rules and usually broke them very heavily and they go to jail. So that's another misconception as well. But all that being said, it's an incredible game to play with. And it's produced some of the wealthiest people on earth. If you look at the Forbes 100 list, almost a majority of them is from the fund or financial space. This game is what creates some of the wealthiest people on earth.
No, thanks for sharing. And I think that's what I hear the most often is the concerns about legal or rights or it's shady and things. And it's funny, I tell people it's one of the most highly regulated spaces out there. And so sure, there's shady people in every avenue of any kind of investment vehicle, but it's regulated by the SEC, the government's regulating, and there's so many with your PPM and your docs that people can review to ensure that your fund is legit and appropriate. I think, there's been some negative fund talk out there, obviously. And so with so much negative press, what are some ways you're speaking to people now with to just talk to them about funds and with, even your own fund with crypto being so kind of just scary out there, right? And maybe an unregulated area. What can you share with investors out there to make them a little bit more comfortable investing into these funds?
Well, yeah, a couple things to unpack there. You have syndications and funds. I actually had a guy last week. This is actually very common. Most people that, point out this guy's a scam or whatever, they actually aren't registered with the SEC. I had a guy last week, he pitched me on this huge deal. I was going to do it. And he just said, and then at the end he goes, yeah, we don't like the SEC. We choose to be unregistered on all of our stuff with the SEC. And which you can do, by the way. Real estate is you have a lot of exemptions with real estate and stuff. And I looked at him, I said, well, do you guys have audits, third parties? I looked at it and finally I was just like, I just didn't like it. And what happens is a lot of the people that are scammers typically decide not to register with the SEC, which in real estate, sometimes you can decide either way how you want to structure your deal. And then what happens is there's a reason they don't want to register with the SEC is because they're maybe doing something shady. It's very easy to register. It's super easy to register with the SEC. It's very easy. You just go through FINRA. There's a lot of easy stuff to do. But if the reason that they don't want to do it makes me kind of sketched out. So people that are registered with the SEC, I actually really like. I want them. If I'm investing in a fund, I want you to be registered with the SEC. I want to see your filing code. I want to see your Form D. I want to see your Form ADV. I want to see all this, your audits done, because it gives me tons of confidence that you're playing by the rules. And I want to work with people that play by the rules, and which is awesome. Because if you're not playing by the rules, by definition, you're probably doing something kind of shady. So that's the first thing I would say. I prefer investing with a huge multi-billion-dollar fund, which I'm in 2 funds that are, multi-billion-dollar funds, rather than a local guy that's syndicating capital. Because the chances of fraud between those two, the one that runs multi-billion-dollar, yes, they could commit fraud, but the chances are very low. When you have all these institutions looking at them, all these audits, they have KPMG, they got everybody looking at them and auditing them. Versus a local guy that can't pay for an audit, that can't do all that stuff. It's, I'd rather invest with the fund first off. Now, a couple of things when I talk to an investor, let's just do real estate since you guys talk real estate here.
Sure.
There are pros and cons, and there's nothing wrong with syndications. We actually help a lot of people in our group do syndications. I just think do them the right way. Don't do them in a sketchy way. Do syndications the right way. But if you're doing syndications versus funds, let's just talk about that for investors. There's the pros of a syndication is you can invest right into a deal. You can see the deal. It's tangible. Funds are usually, they call them blind pools. So they'll say, hey, we're raising a fund to go out and do X type of deals, and we're going to do those over the next 36 months or something. So I'll kind of give you pros and cons. We had a guy in our group, example, he was a house flipper. He flipped 4 houses a year. doing syndication. So every, couple months he'd find a deal. He'd go get bank money, hard money, his own money, investor money, pool it together. He'd then go out and set up an LLC. They'd put the money in. He'd then go flip the house and then he'd start over and he'd make, $50,000 a house flip, which was pretty good. He kept doing this. And then finally I said, hey, do you want to do a fund? And we actually set up a fund for him. He flipped 72 homes the next year out of a fund because he didn't, every time he found a deal, he'd have to go call everybody up. He's on the phone. He's trying to get money in. He had a fund set up once. He had the documents, the capital raised once. He had the bank relationships already set up. And so he could go flip as many homes as he wanted. He had economies of scale. If you're a house flipper, you guys are smart real estate people on here. If you, do you think you'd win more deals or less deals if you had a fund ready to go when you're bidding on properties? You'd probably win a few more deals because other people are like, hey, I need 45 days to syndicate capital. It's like, dude, I got money I'm a full cash buyer. I'll send you money tomorrow. Right?
Yep.
You probably win more deals. Do you think you'd get better financing from banks with a fund? Well, yeah,
absolutely.
You're a repeat customers. Banks like to work with larger customers and will give you better rates. So your cost of capital, your debt goes down. Additionally, hard money lenders, if you're in that route, they'll also give you cheaper rates because you're, again, a repeat. They want to go for a volume play. So all of a sudden, you can close faster and you can actually do cheaper. You can actually bid higher. You can outbid because your debt service is lower. Additionally, on that guy flipping 72 homes, he had economies of scale. He had multiple crews that would just go from house to house. He had a tile guy, a carpet guy. They would just do all of his properties. And because of that, he could pay them an average cost per house went down. So he has more margin per house. So all of a sudden, he can outbid his competitors because he has economies of scale and better debt. And he can close and win more deals because he has speed of capital. If you're ever bidding on a property right now, you go, man, whoever wins that deal, they're an idiot. They overpaid for that deal. Well, are they the idiot or are you the idiot? They might be playing a different game than you. 1 in 5 homes last year were purchased by funds. 1 in 5.
That's nuts. I didn't know that.
Which is insane. The year before it was 1 in 7. Last year it was 1 in 5. And you go, man, they're paying overpriced. Man, these guys are going to get hosed. Well, really? Are they the idiots or are you the idiot for not figuring out how to get cheap debt and turn? And they're playing a bigger game than you. And so then also for investors, you can tell investors, hey, we're going to do 75 house flips next year. Yeah, we can do a one-off deal here and there with syndications, but I'm going to have to call you up. We got to get money in. It's always we got to get documents signed every time. And additionally, that deal might do well. It might do medium. It might do poorly. But if we do 75 homes, you're going to be diversified across all 75 homes. So yeah, 5 homes are going to kill it. They're going to just do amazing. 5 homes might lose money. The other 65 homes are going to have an average return of, X percent, and you're going to get a diversified return. And by the way, I won't be bugging you every 2 months to send more money in. That's why we're moving to a fund model. Oh, and also, by the way, I'll just share this. For you as the manager, there is way less risk in a fund. In syndications, the partners or people that you bring in, depending on how you set it up, oftentimes can sue or kind of elbow people out of the deal. For example, if you had a big investor, let's say your biggest investor in a syndication says, hey, Bridger, you know what? I forgot to pay taxes last year and I need some capital. I need some liquidity right now. Can you sell the syndication property and get me my money out? And you're like, well, I don't know. It's not ready to sell yet. Well, hey, dude, I've given you the most money. You need to sell. I need my money out by the end of the month. And you're kind of obligated to kind of sell that property. Even if you have other partners and stuff, this is your biggest investor. And he's like, hey, I'm going to sue you. And it's like, oh, shoot. Okay, you know what? We got to sell the property. In a fund, because of the way you set it up, they are limited partners. They have limited liability and limited control. If you guys have seen the movie The Big Short, it's a great example. Michael Burry is in there. He's got this huge short on the housing market. And every month he's paying somewhere between $1 to $7 million of premiums just to hold his position. So every month they're losing money to just hold the position while he's waiting for the housing market to crash. And one of his biggest investors walks in, and there's a great scene in the movie where he's yelling at Michael Burry. He's like, Michael, give me my money back. Give me my money back. And Michael just goes, sorry, the housing market's going to crash and it's tough. That's the power of a fund. That's why most people that are good at this game end up running funds one day. Your biggest investor, they could have given you $100 million. And if they didn't pay tax last year, they're trying to pull money out, whatever, you say, sorry, I don't serve individual investors. I do what's best for the fund. My fiduciary responsibility is best for the fund. And these properties are not ready to sell yet. So I'm sorry, your money's locked up. Now, we have a clause in our PPM. If you want to pull money out, it's a 50% penalty. So you can pull money out. It's a 50% penalty. Or you can sell your shares in a secondary market to somebody else. But as far as the fund goes, I've got to do what's best because I have hundreds of investors on this thing. I've got to do what's best for the fund, not an individual investor. Again, that's why most people that are successful in the game of finance and this game of real estate and deals almost always end up running a fund. That's the end result because of the scale, the protections, and all the good stuff I talked about earlier.
Yeah, ton of great stuff. So what's maybe a negative? Like what's one or two, like why do people not, or why does it take so long to get to this, accelerated or graduated game of funds, right? Like I wish I would have known about funds, 2009 when I started investing in real estate. I found about them, last year in 2022. So what's a negative about funds?
Well, you just hit it right there. I mean, most people just don't know about funds.
Yeah.
This is even, they think they got to go to Harvard or work on Wall Street. They just think it's not an option. Now, the other thing, a negative, it's more expensive. So, we kind of say low end average, low end is like $25,000, $30,000 to $35,000 just for legal docs to set up your fund. Mm-hmm. So there's a barrier of entry, just legal cost to get in. And we help people do that for a lot cheaper and stuff. But as if you just look online, that's kind of the low end, some funds are $50,000, $60,000 to set up. Additionally, it's a bigger responsibility though. Funds aren't for everybody. I'm just saying that straight up. It's not for everybody because you're not just doing a one-off deal. You've got to get good at systems. You got to be good at flipping 75 houses next year. That takes a different level of management and a different level of scale. And so that's again, why most people, and by the way, I think syndications are great. It's a great way to build a track record. You should start with syndications, but have it in the back of your brain. Like one day I want to be doing this in a fund. Because I know, and you'll get big enough in syndications where you're managing 30 deals. You got different investors and clauses, and you got to do K1s and taxes for all different 30 properties, and they're all separate. Yep. And it's like an accounting nightmare.
Thank you for listening to the Hot Real Estate Investing Podcast. Check out our website, hotrei.com, for additional content and resources. And please take a moment to subscribe and leave a review so we can continue to bring even more value to others through real estate investing.